Hi everyone, welcome to my channel Fast and Curious, where you get all the stock market related learnings on a single channel. So the topic for this week is one of the key topic wherein if in any news channel it gets reported that that key term has been reduced, that leads to a fall in the stock's price, or if about that key term that that has been increased, then that results into the stock prices going up. So have you ever wondered how investors measures a company's real profitability? Well, it's not just about net income. Meet EBITDA, a powerful metric that reveals a business's true earning potential, and its best friend, EBITDA margin. Stick around and I'll break them down in the simplest way possible. So, what exactly is EBITDA? It stands for earnings before interest, taxes, depreciation, and amortization. In simple words, it tells us how much a company is making from its core business before considering financing costs and accounting deductions. So, formula for EBITDA is equal to net income plus interest plus taxes plus depreciation plus amortization. Think of it as your business's raw earning power before loans, taxes, or machinery wear and tear come into play. So, let's talk about EBITDA margin. This tells us how efficiently a company turns its revenue into profit. So, the formula for EBITDA margin is equal to EBITDA divided by total revenue and the percentage of it. So, let's break it down with a simple example. So, suppose you own a coffee shop wherein your revenue per month is 1000 rupees. The expenses, that is the expenses on costs, the raw material costs, the operational cost is 900 rupees, and the depreciation and amortization, that is the wear and tear of the machinery that is being used in the coffee shop, is rupees 200. So how the EBITDA will be calculated? EBITDA will be calculated as revenue minus expenses plus depreciation and amortization cost. That is rupees 1000 minus rupees 900 plus 200, that comes out to be rupees 300. And how the EBITDA margin will be calculated? EBITDA margin, as I explained it to you, EBITDA margin is nothing but the total EBITDA divided by total revenue, that is 300 by 1000, which comes out around 30%, which means, so if a cafe makes rupees 1000 in sales and its EBITDA is rupees 300, its EBITDA margin is 30%. That means for every 1 rupees earned, 30% contributes to core earnings. So now what's the difference between EBITDA and EBITDA margin? EBITDA shows total earnings before interest, taxes and depreciation. EBITDA margin shows the percentage of revenue converted into profit. EBITDA is great for comparing earnings between companies, while EBITDA margin helps measure efficiency. So why do investors care so much about these numbers? EBITDA helps compare companies by removing financing and tax effects. EBITDA margin reveals efficiency in converting revenue to profit. Higher EBITDA and higher EBITDA margin means stronger business performance. But there are some limitations of EBITDA and EBITDA margin. EBITDA is not actual cash flow. It ignores debt payments and interest, excludes capital expenditure, that is capex, and can be manipulated by companies. That's why it is important to look at other financial metrics like net income and free cash flow too. So now you know why EBITDA and EBITDA margin are essential for analyzing business performance. They reveal profitability and efficiency but should always be used alongside other financial data. So the key takeaways are EBITDA measures raw profitability, EBITDA margin measures efficiency. Both are useful but not perfect. If you like this video, hit the like button, subscribe for more simple financial breakdowns, and comment below what company's EBITDA should we analyze next. Thank you everyone.